Welcome to the Infra Insider podcast from Infra-Be, a leader in renewable energy and infrastructure executive search. Join us as we dive into insightful conversations with industry leaders, pioneers and visionaries shaping the future of infrastructure and renewable energy. Discover the latest trends and innovations and challenges driving the transition towards a greener and more resilient future. Please remember to like and subscribe. Welcome to the Infra Insider. Today we have a fabulous guest, Kevin Yaich. Kevin is currently head of M&A at a US renewables business called Qcells. I've been very fortunate to know Kevin for probably about sort of 6 or 7 years now. Have been fortunate enough to help find his role at Shikun Benui, where he put that business on the US renewables map, and now finds himself in an exciting role at Qcells. Kevin, welcome to the show.
Thank you, Daniel. Thank you for having me.
It's great to have you, and we've talked about having you on the show for quite some time, and perhaps most opportunistically, we have a new administration in the US, and whilst that will not form the centre of our discussions, I'm sure will be an interesting point that our listeners will maybe want to understand in terms of how you feel about it, how the future of renewable energy is going to be looking in the US. But before we get into that, Kevin, tell us about your journey. Give us your background and how did you end up in renewable energy and actually in the US?
Sure, absolutely. So again, thank you for having me in your show. Very grateful to be part of your podcast community. So thank you again. So as you can hear, I have a slight French accent. So I'm originally from Paris, France, not Paris, Texas. I know it could be misleading. So after business school, I moved to the US to do investment banking for JP Morgan. I was part of their M&A team in New York. Then I went to do some private equity and had the opportunity to be exposed to the energy industry. At that time, the renewable sector was starting growing, but it was...
What year was that?
I moved to New York in 2004,
right,
and
okay.
did private equity from 2008 to 2011. And so I started being very interested in the renewable space. I was based in Florida at the time, and conveniently, what is now the largest renewable IPP was based locally, NextEra. And I joined NextEra and in a fabulous team, get the opportunity to work in many different areas, always transactional, but from corporate development to project M&A for 8 years. And that's how I did my first step in that space. Then after that, I had the opportunity to launch the renewable activity of SNB, which is the largest Israeli IPP. So very blessed to have the opportunity to build a team and launch the business, build our portfolio. We went public in the Tel Aviv Stock Exchange, so incredible experience. And Qcells and Vitaly Lee, the CDO of Qcells, approached me, I would say almost a year ago, to come and lead the M&A effort of the organization here in the US. And I've been doing that since then, and very, very excited to be part of an international conglomerate like the Hanwha Group, and being able to fully deploy our capabilities in the US.
So kind of like three similar sectors, but very, very different journeys within each of them, I imagine.
Yes, absolutely. From all a different angle, right? So I started what I call jokingly the dark side of our value proposition. I used to be an investment banker. It happened to good people.
And that's
Uh,
interesting, isn't it? That's a really interesting point that you started in investment banking and ended up here. You know, more often than not, people are trying to get into investment banking as opposed to the other way around. So it's great to see, obviously, that you've used that skill set in this way.
Yeah. No, actually, investment banking, especially back in the day, you worked a lot. You were exposed to a lot of transaction. Obviously, when you start as an analyst, you don't do the most interesting work right away. But investment banker in the US at large organization, large financial institution, those are rock stars. Those guys work 15 hours a day. And as a young professional, you get exposed to such a fast pace. In 4 or 5 years, you learn as much as working 8 years in corporate America because of the pace, right? You don't have any other choice to learn a lot and to keep up with the pace, especially when it's not your native language. Actually, it was on the beginning a challenge, but because it's not your native language, you
Mhm.
have to go straight to the essence of what you're doing, and I think it was very beneficial for me. So very grateful for those opportunities. And a lot of people start by being a banker, right? It's because they have such a good training program when you
Mm.
finish business school. And again, you get the opportunity to work a lot, get a lot of exposure. And when you're a young professional, you have the time to do so. When you have a family, it's a little bit more challenging. So no, so I think I would not change anything in my journey.
Perfect. So let's talk about Qcells. So they seem to be making some real waves across the renewable energy sector. Um, what's their story?
Yeah,
And ultimately,
absolutely.
what's the business model there?
Yeah, no, absolutely. So Qcell is a very unique business model as we are very integrated, vertically integrated, but we are not an IPP in a way that our business model not is not intended for us to be long-term owner of assets, right? But we are very integrated. We are both active in the CNI or distributed generation business and the utility scale business. We um, we have a very strong development team, so we develop greenfield our own project, or we take over projects that we acquire, and with full development capabilities, we bring them to NTP. Then we have a fully staffed EPC team that built our project and third-party project. And what set us apart is the fact that we are module manufacturer as well here in the US. We have two facilities, one that will complete its construction later this year. And with our two module manufacturer, we will be the largest module manufacturer in the US with
That's
more than eight,
that's incredible.
yeah, with
Did
more
you?
than 8 gigawatts. So that set us
Wow.
apart, right? Because we
Yeah.
develop project, we have EPC, we build our
Yeah.
module, we have O&M services. So we have a system integration for battery. So we are controlling
Mm.
to a larger extent our supply chain and our value proposition. It's pretty unique in this current environment. It allows us to propose premium products and
And that's
premium
obvious.
services.
And obviously, in the current environment, where it's slightly more competitive, you can obviously increase returns significantly, be it that you're manufacturing as well.
Yes, and for our customer, I think there is always, people talk about price when you talk about building a project, but equally importantly is, when you have your price on paper, there is a risk associated to it, right?
Yeah.
How sure that you can deliver a project on time, on budget, and being able to secure the long lead equipment, whether it is module or other type of equipment, or even securing EPC, right? This is one of the bottleneck in our market. So no, that's we have a unique value proposition that set us apart, and very excited to be part of that story.
Yeah, I mean, it sounds like you must have a really dynamic team because your proposition is really quite complex. So you've been brought into the business as head of M&A. So in terms of your role, what are your targets to kind of, bring further value and success to the business?
You
How
know,
do you see it?
no, no, absolutely. So, anyway, for us, it's all about team, right? As you say, we have a complex business, so it is not what individual team is doing. It's more our ability to all work together, right? Between developing project, buying or selling those projects, financing them, providing EPC services, bringing the module in. So I think it is uh, my part, my contribution, my team's contribution in that value proposition is to buy project to add on to our pipeline to match our goal, whether it is our earning contribution goal or our commitment to our partners. That's one. Second is to, together with our project finance team, being able to sell those projects. Sometimes we sell projects that are not core to our strategy a little bit earlier in
Mm,
their life, but most of the time we try to sell project at NTP or COD, right? So we are, our team is at the front end and the back end of our value proposition, which make it pretty interesting for us.
yeah, no, absolutely. So you've been in renewables for like well over a decade, right?
You make me feel old.
No, I'm not trying to make you look old here or feel old. How can I look at you?
Yeah,
But what, 12 years, and in that time, the sector must have just changed so
absolutely.
much. And I think I feel, working in the market, I feel that the last 12 months has been significant change, and I feel like the future, there's lots of opportunities, there's loads and loads of challenges. But from your perspective, as a professional who's right in the market, where do you see the most significant change or development over the last
Sure.
year, and how's that going to impact the market moving
Mhm.
forward? And when I say the market, specifically the US market.
Yes, no, absolutely. So I would say that up to the last couple of months, I would say that there were a significant paradigm shift in, couple of years ago. Historically, up to 5 years ago, the bottleneck in our industry were utility PPA, right? Getting a PPA was the holy grail because the CNI or corporate PPA were not yet extremely mature and developed. Most of the PPA were coming from utility. So the main focus was go secure your PPA, and then, in a cost declining environment for procurement, then we just had to estimate the declining curve and figure it out, right? Um, securing side, renewable was not as prominent as now, so it was not the bottleneck to get the good side or connecting to the grid. It was really the PPA. Then I would say between 5 to 3 years ago, um, a lot of the utilities start doing more and more rate base. So a little of a decline of appetite for utility PPA, but more importantly, the CNI need and ask for virtual PPA corporate offtake really rise with the ESG goal that all the large corporation, either international corporation like the hyperscaler or local CNI. So then suddenly you had a lot of opportunity for offtake. It was not a binary dynamic. So, and in the meantime, renewable penetration increased, which creates stress in the grid and ability to interconnect. So the bottleneck became more and more interconnection, quality of the site, and more recently in the last 2 years, especially since COVID, long lead equipment access, right? Being able to secure breakers, transformer, and those type of things. So, and the cost associated to it, right? So you had a significant volatility in the cost of whether it is module and other raw materials. So I would say that now, developer would sign their PPA last, but first would secure EPC, module, de-risk the site, and then get a PPA.
Right.
Because you could secure once you secure your PPA, unless you want to reopen it, which is not a good scenario, it is what it is. Your top line is set, right? Then if your cost increase, it deteriorates the economic of your project. So that's, I think, a big shift where the PPA become last and locking the price, which is the fixed amount of the value of the economic of your project, right? So I think for me, this is the biggest shift. And now you have a new shift, right? Very unusual things in our market. Like for so many years, when you were forecasting need of power, it was barely flat, right? You had, on one hand, you had population growth and EV penetration that was increasing the demand, which was flattened by energy efficiency. And the rise of energy efficiency across the grid. So it was kind of a flat demand. And now with the growth of data center and AI penetration in our market, you see a rise of demand and that we haven't seen in years, right? So then it's a new dynamic, like how we are going to meet this demand of power, and with the bottleneck being obviously procurement of material and the grid itself.
I'm glad that you mentioned data centers. It is obviously, very, very interesting, hugely related into AI. Is that the next big thing?
It has been the next big things for a while already, right? The question is, it is here, it is a fact, right? Whether, AI efficiency would lower a little bit the demand of power or not, whether AI would be bigger or low or smaller than what we think. I mean, the impact remains the same. You have a significant need for power, and the question is how we're going to meet that demand. And I don't think anyone has a solution. We have a lot of smart brain in our industry, and we are all together trying to figure it out. And what is interesting is when you go to conferences, the pie is becoming bigger. The problem are more challenging. So you see our community trying to work together to find solution versus like competing with each other. So it's a very interesting
dynamic. That's nice to see. Listen, that is nice to see. So look, all of these changes, all of these developments, I've noticed, I might be wrong, I have been wrong, but I've noticed there's a general uptick in M&A activity at the project level in the US renewable energy market. Is that right, or?
Yeah, no, absolutely, but different, right? I think you had you can have a lot of M&A in the market for different reasons. One, it is a bullish market, and everybody wants some renewable project. So high M&A activity, which has been the case over the last 5 years. Or you can have a strong M&A market because the market is somehow more bearish to some pocket in the market, and then it becomes a buyer market, and there is a strong entry point for new entrant or for well-capitalized developer or fund, right? So I think we are entering the latter a little bit last year, but more this year. That's what I'm projecting. Fundamentally, I think that it is a little bit more risky to develop project because it takes longer. You have to put more capital at risk earlier. With in the case of the interconnection, for example, you have withdrawing penalties that are larger and more challenging to underwrite for the equity capital market. So on the one hand, it is a little bit more risky to take development risk, especially early and mid development risk. And on the other hand, when you look at project level return has increased, decreased over years, but the spread to the risk-free rate, what I've been seeing has not significantly increased. So so when you see the return increasing on NTP or COD project over the last 2 years, yes, people would, non-financially savvy people would think that, oh yeah, people make more money on the project, return are greater, but it is a little bit misleading because the spread to the risk-free rate has not increased compared to 3 or 4 years ago, right?
Right.
When you were buying a COD project, when the interest rate were at like 3.5%, you were getting somewhere in the 8% range, right? Now you get 10 or 11%, but the interest rate are 200 basis points higher. So the spread hasn't changed much. So what it tells us is the reward for the equity market has not improved while the risk is higher. So I think a lot of the investor community has been realizing that, and because they are not rewarding more than buying a project that is de-risked, I'm seeing more capital going to de-risked project, buying at NTP or COD, right?
Confidence had to come back.
No, absolutely. And no, I think it's not really confidence. It's being able to reward properly the risks that you're taken by coming earlier, right? And so what you're going to see, obviously, you still have a lot of capital going to development risk, right? But I would think a little bit less compared to the growth that is coming to us. So what does it mean? It means like some developer will have to rationalize their pipeline. Because if they have, 20 gigawatt pipeline, but only 15 gigawatt worth of DevEx to fund their pipelines, they will have to sell down 5 gigawatt. And I think you will see that a lot in the market, which means that last year I saw a little bit of that, but the project that was sold, early or mid stage, again, the business model of the LNTP of the NTP seller. Were more like, I would say, not the best project in the portfolio. Right now, I think it's going to be different. You will see more projects coming because people will rationalize by selling a state where they are going to divest from a specific state or from a specific type of offtake. So I would anticipate to see better project available. That's what I'm seeing.
That's good.
Better quality project, not selling the bad project in your portfolio, but selling more like region-based type of divestiture. So I'm excited about it.
And maybe less competition, or than when
No, I think when by definition, if it's a seller, if it's a buyer market, you have less competition, right? So, but this lower competition, I'm not anticipating a big decrease in dev fee because not specifically. I would say that you're going to get better project for the same dev fee that what you would have gotten last year. That's one. But the other point I would like to highlight is good project will always sell at a very high premium. And by good project, I would say projects that have energy community in a high PPA area with a clean site and who have long lead equipment secured. Those one you will have top dollar buying those projects, especially if they're fully de-risked.
Absolutely. And so with that, obviously, the valuation trends, there can be a bit of a roller coaster, can't they? How have you seen those valuations change? And obviously you've discussed some of it, but what's driving the volatility of valuations in the US market?
Yeah, so I think, as mentioned, valuation on projects that you will sell at NTP or COD, it's, a premium to the risk-free rate, right? I'm seeing it anywhere between 400 and 600 basis points above your treasury yield. So depending on the quality of the project, the tenor of the offtake. So that's one thing. The second is if you sell project, I mean, the main difference between selling project at NTP or earlier or at COD, if you sell a project at COD, first, you're touching a different universe of potential buyers, and they will look at your project like a cash flowing asset. So they would not look at development fee comps. They will solve for a return. When you sell a project at NTP or earlier, obviously you're going to, as a buyer, run it through your model. But once you run it through your model with your expected rate of return,
Yeah.
it speed up a dev fee. But this dev fee, you're going to sanity check with what the market look like. So if you have an amazing project with a very high PPA, but you buy it at NTP or earlier, it will be very difficult to pay extremely high premium compared to comps. Where if you sell it at COD, it's going to be cash flow driven, so you will probably get more value. But ultimately, buying a project at NTP versus COD, from a developer standpoint, when you bring a project to COD, you take construction risk, you have cost of financing, and you have to raise tax equity and debt. So you have to probably have a full team that allow you to do so. So what I'm seeing is unless again you are in a unique situation where you have a lot of cash in the project through a high PPA or a unique situation, the premium when you put all the cost and the risk related to bringing a project from NTP to COD or selling it at NTP, I don't think the premium you're making is that much more. Again, depending on the market, right?
Right.
But
Okay.
yeah. So again, I think sometimes it's more an art than a science, and you have to to do a good arbitrage on the value. But some market with kind of like below $50 a megawatt hour PPAs, I don't think on an ROE basis you're going to get a lot of upside by bringing it to COD versus selling it at NTP. But if you sell
Yeah.
it to a PGM or Pacific Northwest market where PPA are above 70 or $80, then the assets are extremely have a very high cash flow. If you have an energy community or domestic content award, you can probably generate a
Can you
significantly
expand
higher
that?
premium at COD.
Can you expand on what you mean by energy community? I think people would
Energy
be interested
community,
to
it's
understand that.
in the US, you could be awarded an incremental tax credit if you are located in specific area. So typically those area are either you are in a certain level of unemployment rate compared to the national average, or located to retired coal plant, etc. So those type of area allow you to get an incremental 10% of ITC. This 10% of ITC, if you are if you are in a specific area with a higher cost, could worth 15 cents of dev fee, right? So
Yeah.
if you add that plus potentially having domestic content product and being in a very high PP area, you could end up having a dev fee of 50 cents, right?
Oh
In
wow.
some unique situation versus, and if you sell this very same project at NTP, would
Hmm.
someone pay 50 cents for a project? I don't think so, because they look at the comps and they will say, "Oh, this is insane. I will not pay such an amount of money," right? While if you say it at COD, you think of your project more like a cash flow generating asset, and the value is a value based on your expected rate of return. I think you're in a different dynamic. That's where you have to make the arbitrage, right? If you are obviously in a project that would take PTC in a low PPA area, low cost area, the difference of what you can get at NTP versus COD, I think that it doesn't really worth the trade-off,
Okay.
and you're better off selling at NTP and not taking construction risk, etc., etc. So again, it depends on the market and how you're going to do a value arbitrage here.
There's still lots of nuances, but a good project is a good project from the outset, really. You just know and know what that feels and looks like. Looking ahead, what specific markets are you most excited about when it comes to deploying development capital? And why do they stand out for you right now?
Yeah, and and the way I look at market is a couple of things, right? Always how hard it is to develop in those markets, the opportunity for offtake, and whether you have utility opportunity or corporate, and obviously hyperscaler is a big driver. And then after you have to look from um, a corporate standpoint, where do we have institutional knowledge in those markets? Because that's one thing, wanting to be somewhere, but there is another thing of being able to develop in that area because the team is
Right.
experienced. Our EPC team has developed projects. They know where are the pitfalls, etc. So when I take all that together and market fundamental and our experience in those markets, obviously I'm excited about PJM. It's a tough market because uh, the topography, the geotech on those sites are challenging. But at Qcell, we have developed and built a lot of projects in those areas. So we have a strong differentiator. So the combination of us, our institutionalized knowledge in our value proposition, combined with a market uh, that has a lot of load coming, right? And high PPA, possible energy community for project. All that put together make it an attractive project. Tough, but attractive for us. I'm very interested in the Pacific Northwest area, which has been historically more wind focused, but still untapped because those are regulated markets. There is a lot of appetite from hyperscaler as well on those markets. So I like those markets too. Uh, some area in CERC, there is strong demand in Georgia and in Duke territory. I think there is a strong demand. It's pretty competitive, right? Lower PPA environment, but I think there is a lot of opportunity here. And I'm keeping an eye on ERCOT. It is an interesting market. Um, you know, I think there is a lot of demand for power in this market on the one hand, but on the other hand, it is a little bit challenging to finance. The appetite for tax equity investor is 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 limited or not as much as what the demand of project is.
Yeah.
So, but we're keeping an eye on that market too, because you cannot disregard ERCOT, because today it's probably not as investors are not as bullish, but yesterday they were extremely bullish on this market. Tomorrow they will be bullish again. We just have to time well our participation to that market.
Yeah. May the bullish market return quickly.
Exactly.
When I
Exactly.
want to, sorry, Kevin.
Yeah.
I wanted to ask you one final thing, and this is something that's come up in discussions that I've been having over the last sort of 6 months or so with various clients and people across the industry, and that is project attrition. Always seems to be a huge concern when acquiring projects. So, in your experience, what should investors focus on to ensure that the project stays on track and that they can move forward successfully after the deal's done?
Yeah. So I would say, no, very good question, and it's always, the number one question that our CEO, IP Kim, is always asking us when we come to investment committee is like, Kevin, can you guarantee me that we're going to bring this project to the finish line? Of course, I'm telling him, of course, I cannot guarantee you, but no, but no, joking aside, the best way to protect yourself for attrition in M&A is to do a diligent, well-coordinated effort in reviewing the project pre-acquisition, making the right diligence, spending the extra bucks, and the extra amount of time, having the right team involved to eliminate the fatal flaws or getting in the transaction knowing where the risks are. So that, I think, is the number one. Not having bad surprises when it's time to do a design and realizing that only 50% of the site can be built, right? So early diligence, early engineering is key. Once you acquire the project, the key component is sticking to the plan, being very disciplined in developing, de-risking the project, because project development is de-risking an opportunity day after day. So we at Qcells, we have an amazing development team, an amazing interconnection team, and origination team, and same thing with our EPC team. We all work together. And the other thing that is very important is good coordination between the team. So nothing fall through the cracks, right? Because there is a lot of pitfalls, a lot of possibility to make mistake. And as well, a big part of our development effort is continuous engagement with local communities, local agencies, making sure that we have good communication. You develop a project, the community can be afraid, they have questions, they don't know, right, about those technologies. So being fully engaged, making sure we are doing the right things from an environmental standpoint, from a cultural standpoint. So all those diligent and disciplined project management function are key for what we are doing. It's, once you acquire a project, there is a lot of project management that is coming in place. So making sure that we are doing that, and last but not least, keeping two things on our radar. One is the time, right? Making sure that we are developing this project, ensuring compliance with the different milestones we have under the PPA and the interconnection agreement to be able to bring the project online on time, because it's not just only about the project itself, it's because the utility or our customers are relying on us because they need the power, right? So that's one. And second, being able to build it on budget, right? That is very important. Staying on budget, doing a continuous work on the procurement side, and making sure we get the best quality at the best possible price to maximize the value of our project for our shareholders.
Fantastic. And as a module manufacturer, you get a bit of a leg up with that as well, I'm sure.
It helps us for sure. This is, I think, one of the elements of the life of a project, of the early life of a project, that we have a little bit more control than someone else.
Thank you. Kevin, thank you so much for your insights today.
Thank you.
I've learned a lot, some of which I'm going to go away and Google to understand a bit further. But no, it's interesting. I think on the whole, I think investors should feel very, very positive about investing across the US renewable energy market. And we look forward to see what 2025 is going to bring. You promised me before the call it's going to be a fantastic year, and there's going to be loads of recruitment for us to do. So I'll hold you to that. Perhaps we can touch base again around about this time next year.
Thank you, Daniel, for your time.
Thanks, Kevin. Take care.
Bye-bye.
Bye.